After the small if-any quiz that you've written on manufacturing, I've received a number of emails, WhatsApps, whatever, where students have informed me they worked very hard and they had 1 out of 10 or 2 out of 10 or maybe 0 out of 10. And there must be a mistake in the questions and in the answers. Guys, I can assure you there's no mistake. There was one mistake and I stopped the test and I rectified the mistake. And well, remarkably, most of the students who have finished the test by then, in any case, chose the correct answer. So, yeah, the problem is not in the test. The problem is not in the answer. The problem lies with you guys who do not really understand with what you're busy with. So what I'm trying to do here is to tell you exactly what is the principles behind manufacturing. Because if you do not understand the principles, I'm going to catch you out each and every time. Now let's start from the top and then we work downwards to the final answer, and then we're going to play around a little bit with the figures. And I'm going to do that as far as possible without any figure work. I want to talk about that. So the first thing that we have is our direct material account. Now, what do you have to know firstly before you start off with your direct material account? You have to know what is the valuation method that is applicable on your direct materials. Now, typically in your scenarios, you will have either going to work on, first in, first out, or you're going to work on the weighted average cost method. It's going to be either one of these two. What is the other alternative that we have done with you guys? That is a specific identification method. It's not to say I cannot use that. I can use a specific identification method, and you must still know exactly how to value inventory if I do use the specific identification. Let's put it down here. It is also important that you understand how to do that. But in most instances, in practice, it's either going to be FIFO or WAC. Now, let's insert here another line. You're going to start up with an opening balance. Now, guys, this opening balance is going to be a number of units, which is a part of your direct or your raw material, the total value of that direct or raw material, and you will be able to calculate a price per unit. Why? Because when we work out the cost of raw material issued into the production process, and when we work out the closing balance of raw material still on hand at the end of the year, I need things like units and prices and units and prices, and depending on what valuation method I'm going to use, that is going to determine what is the value of the direct material issued into the production process and the closing balance. Now, why is that important? Well, the cost of direct material issued into the production process is going to form part of the cost of goods manufactured in the current financial period. Now, why is the cost of goods manufactured so important? Because, guys, in a normal trading environment, you will have a trading inventory account. What do we account for in the trading inventory account? Opening balance plus purchases less closing balance, or less cost of sales equals closing balance. Right. So, in a manufacturing environment, that purchases is now replaced by the actual cost of goods manufactured. I do not buy a finished product and I sell a finished product. I make a product. So I need to know what did it cost me to make a product which I'm going to sell. What is my profit going to be? Whatever I'm going to receive for the product that I'm going to sell, less what did it cost me to manufacture that product. That is profit. It doesn't change. It cost me something, I receive something, the difference between the two equals profit. So therefore it's important that I must know exactly how I must determine the value of this direct material or the raw material that I've used to complete products during the year. It is a cost component of my finished product. Good. Now, if I have worked on FIFO, we would have said that the direct material that I've issued into the production process will be the number of units that we have issued, and we will start off with our opening balance. So we would issue this number of units first at that cost, and that will form part of work in process. And then we are going to do more purchases of raw material, and then we will issue of our purchases going from top to bottom based on the units that we have purchased, whether that falls within this number of units that we have actually issued at the price per unit. Very important is here that you should realize by now for sure, if you don't know that, you are in deep trouble, that the cost price of direct material or any inventory item that I purchase, or any asset for that matter that I purchase, is now not only the invoice price of that purchase transaction. All the other costs that I have incurred in order to get that asset in my possession, and which will enable me to use that asset for the purpose that I've acquired the asset for, that must now be capitalized as part of the cost price of those items that I've purchased. So that total cost there will include the invoice price of the goods purchased plus all other purchases related costs to get that specific units purchased in my possession so that I can issue that into the production process. Good. My closing balance will be the number of units still on hand at the end of the period, whether it's been units, whether it's been kilograms, whether it's been liters, whatever the unit denomination is that I'm using, is going to be the number of units. And first in, first out, we'll start with my latest purchases. That purchased unit cost, that would be the first ones. And then I will start from the bottom and I work upwards until I get to the final total number of units on hand at the end of the period, and each one will have a cost attached to that. I'm going to add all those total costs to get to the final total, the big total, which is going to be included then in my closing balance of goods on hand. If you did not make a mistake, your debits and your credits is going to balance now because it is two separate independent calculations that you've done for work in process and closing balance. So if you work correctly, your account is going to be in balance. If I'm going to use the weighted average method, what do we have to determine first? We have to determine first what was available to sell again during the year. How do we do that? We're going to work with total number of units. What is total units? Total units is going to be the units that we had in the beginning plus all the units that we've purchased. That is going to be total units. And we're going to determine total cost. So those units that we had available to sell, what was the total cost for those units? And I'm going to add all these totals together to get to the total cost. So my weighted average cost is going to be the total cost divided by the total number of units. Now, once I have determined that, then it's easy to work out work in process. If I have the units that was issued, then the number of kilos or liters or whatever that was issued into the production process, I'm going to take those number of units and I'm going to multiply that with a weighted average cost per unit. And that is going to be our work in process amount. So that is going to be the cost price of goods issued into the production process. So once I have determined that amount, I'm going to credit my direct material and I'm going to debit work in process with direct material, that amount that we've calculated there, and it's going to be transferred to the debit side of the entry in my work in process account. My closing balance, I will look at the number of units on hand at the end of the year. I'm going to multiply that with the weighted average cost that I have determined here, and I'm going to get a total there. Again, if I have worked correctly, my total debits and my total credits is going to balance in my direct material account. I've made two separate independent calculations of work in process and closing inventory, and therefore I can be fairly sure that I didn't make a mistake because this account of mine is balancing. So very important, what method of evaluation do I have to use in order to determine work in process, which is going to the work in process account, and what do I do with my closing balance of direct material? That direct material or raw material forms part of my total inventory figure in the statement of financial position. So in my inventory note, I will have a line item, direct material or raw material, with whatever the value is that I have calculated here. Good. In my direct labor account, it will be all the direct labor costs that I have paid during the year. The only other thing that can lie here is accrued expenses. If there was still direct labor costs that I owed in the beginning of the year, or there's still direct labor costs that I still owe at the end of the year, what am I going to transfer to work in process? Only those direct labor costs that I've incurred for the current financial period. Right. So if I've paid you something that belonged to the previous year, I'm going to subtract that. If I still haven't paid anything at the end of the year, I have to add that in order to derive at my total direct labor cost pertaining to the current financial period. So I'm going to credit my direct labor account and I'm going to debit my work in process account. Overheads. Now all the indirect costs that I haven't accounted for, but I was obliged to incur those costs in order to produce and to finish off my finished product. I'm going to accumulate all those costs in my overhead account, and then I'm going to transfer the total of that cost to my work in process account. Just a word of warning here, indirect material, this is not indirect material purchased, this is also indirect material issued into the production process. So if I had an opening balance and a closing balance and a purchase, what did I issue? Opening inventory plus purchases less closing inventory will be the figure that I'm going to use for the indirect material issued. Good. All kinds of other, this is for sure not a comprehensive list. There can be quite a lot of other overheads which I haven't mentioned here specifically. So I'm going to add them all up and I'm going to transfer the total to my work in process account. Very important that you know what is the purpose of the work in process account. What is the purpose? And I hope for sure that you can answer that question. The purpose of this account is to determine the actual cost of goods manufactured and transferred to the sales department in the current financial period. How? If there was an opening balance of incomplete products as in the beginning of the year, I have to account for that because I would have finished those products in this year and that would have increased this amount here that I need to calculate as a balancing figure. If I'm still busy, so on my production floor, I'm still busy at the end of the year with some products, it has not yet been completed, so I could not yet transfer those products to my sales department. I'm going to have a closing balance work in process, and that is going to form part of my inventory figure in the statement of financial position once more. The balancing figure, though, is the actual cost of goods manufactured for the year. So that replaces, if I did work in a normal trading environment, that amount will replace the purchases amount which we had in a normal trading environment. My finished goods in a normal trading environment is my trading inventory. Now, I can never understand that you never have a problem in a normal trading environment with things like opening balance plus purchases less closing balance, but as soon as we get to manufacturing, now suddenly it becomes a problem. Guys, it's exactly the same. Exactly the same. We had in our opening balance a certain number of units. There was a total value placed on it, whatever that is, and that is my opening balance, and I can work out a price per unit. we said that our purchases amount, instead of purchasing a finished product that we're going to sell, what do we do now? We make a product, and the cost associated by making that product, that is going to replace our purchases amount and our purchases entry in a normal trading environment. So now that account there, work in process, that one there, that will then be the actual cost of goods manufactured for the year. Cost of sales, it will be the number of units sold multiplied by the price per unit. I'm going to talk about that more. So that is also the normal trading inventory account. On the credit side is the cost price of goods sold. The closing balance is going to be the number of units on hand at the end of the year, which I'm going to value at a certain method. So again, what do I have to do before I can work out cost of sales and before I can work out closing inventory? I need to know the valuation method that is applicable. So we're going to ignore unrealized profit for the moment. I'm going to talk about that right here after. Let's assume in the first instance that there's no unrealized profits applicable here. If we have used the first in, first out method, how are we going to determine cost of sales? Well, we're going to say we had so much units at the beginning of the year. We have manufactured here the number of units at a certain cost. So that number of units, must be missing. That number of units there multiplied by the cost, that is going to be added there, and that we've said is going to replace purchases. Again, units, total cost, which is going to be that cost, and that's going to give us a price per unit. So that's going to be there. Cost of sales is going to be determined on the number of units sold, and now let's say we've worked on first in, first out. The opening balance we would have sold first, so that would form part of cost of sales. The remaining number of units that we have sold would have come out of this batch that we have manufactured this year. So if we're going to work out a cost per unit, it's going to be that cost divided by the number of units manufactured. So we're going to multiply that by the remaining number of units sold for the year. If I'm going to add both those amounts, the opening balance sold plus the units that we've sold out of the goods that we've manufactured during the year, we're going to get total cost of sales. What is going to be closing balance? Well, closing balance is going to be the number of units on hand at the end of the year. Opening balance we would have sold already, so it's going to be valued at this price per unit, which will be that price per unit. The cost divided by the number of units multiplied by the number of units on hand at year end, and that would have been my closing balance. Weighted average method, exactly the same as what we've said here. It's going to work exactly in the same fashion. What do we have to work out first? We have to work out what was available to sell. Actually, this available to sell is not 100%. That must have been available to issue there on top. The sell is here. Available to sell. It would have been our opening inventory that we had on hand in the beginning of the year, plus the goods that we have manufactured during the year. And that would have given us the total number of goods which was available to be sold during the year. What was the total cost associated with that? Well, that would be the value of our opening inventory plus that cost. How much did it cost me to manufacture those number of units during the year? And that would have been that total. So the total cost, that would have been that total cost there. Number of units would have been the number of units available at the beginning of the year in an opening inventory plus number of units manufactured. So that would have been total units. Weighted average cost would have been that total cost, which would have been that one, plus that one, divided by the total number of units, which is that one and that one. That is weighted average cost. How are we going to determine our cost of sales now? Well, it's going to be the number of units sold multiplied by the weighted average cost. That is going to be our cost of sales. What is going to be our closing balance now? It's going to be the number of units still on hand at the end of the year in closing inventory, multiplied the price per unit will be our weighted average cost that we've calculated here, and that would have given us that number there. If you have worked correctly, opening balance plus work in progress will be that total, and that will equal cost of sales plus closing balance. And if those two balances are the same, then you know you didn't make a mistake. Right. Now we have complicated these things somewhat. But up to my work in process account, nothing changes when there is something that we call unrealized profits. So I'm going to insert here a blue line. And we're going to tell you that everything to that side of the blue line is going to stay 100% intact. What is the purpose of the work in process account? To calculate the actual cost of goods manufactured. Nothing changes. So if we are going to look at our finished goods account, our opening balance now, remember when we transfer the goods from the production area into the sales department, we're going to transfer that at a blown up price, a price that's going to include an unrealized profit component. So that means out of the perspective of the sales department, yeah. Out of the perspective of the sales department, the cost price of the goods that they have received is no longer the actual cost associated with the production of those units, but that would be the actual cost plus the unrealized good profit component. So that means that my finished goods account, all the cost, all the entries in that account include unrealized profit. Great. Now you can tell me, well, but this work in process amount does not include it because it's exactly that account. No, it does not. It's the only item where I split it. And at the end of the day, I add the unrealized profit to the work in process account to get to the total cost of goods manufactured. So if my work in process account there, let's assume it was 1,000, that 1,000 would have been transferred to this account 1,000. Let's assume that we are adding a 10% unrealized profit to the cost of goods manufactured when it is transferred from the production area to the sales department. So therefore, what is going to be the total cost of the goods that we've transferred in the current financial year? 1,100. So when I work further on, I'm going to work with a 1,100. Again, FIFO, I would have sold my opening inventory first, and then I would have sold from this batch, which will be the number of units manufactured for the year divided by 1,100, inclusive of the unrealized profit component. Cost of sales, first in, first out. I would have sold my opening inventory first, and then I would have sold out of this batch of units manufactured for the year. But not only at the original cost of 1,000 rand, the cost component that I'm going to use is 1,100 divided by the number of units manufactured to get to a cost per unit. And that is going to make up part of my cost of sales. In my closing balance, it will be some of these units which I've manufactured for the year that's still going to be on hand. So I'm going to determine the number of units still on hand divided by the price per unit, and the price per unit is going to be on the 1,100 divided by the number of units for the year. So closing balance will also include unrealized profit. So opening balance includes unrealized profit. Here I'm adding the unrealized profit component to get to a total cost which will include unrealized profit. Cost of sales will be based on the total inclusive of unrealized profit, and closing balance will be at the total inclusive of unrealized profit. If I've used WACC, what would I've done? Again, my opening balance would have been my units and a price, and I would have and then I would have transferred from my production area a number of units the total cost there again is not going to be 1,000. The total cost there is going to be 1,100. I'm going to determine what was available to sell, which will be the units as at the beginning on hand, finished goods, plus the units manufactured. That is my total number of units which I had available to sell. What was the total cost of the units available to sell? That will be the value of my opening inventory plus the 1,100. Those two together. So those two together will be part of my total cost. It will be my opening inventory plus 1,100, which would be my total cost. What is my weighted average cost per unit? It's my total cost divided by my total units, and that is my weighted average cost per unit. What is going to be my cost of sales? The number of units sold multiplied by my weighted average cost per unit. My closing inventory is going to be the number of units on hand at the end of the year multiplied by my weighted average cost per unit. And then this account should balance. Now, IS2 says that inventory should be valued at the lower of cost and net realizable value. We have just valued closing balance there of inventory, and we've worked on the 1,100. Was the 1,100 our actual cost? No, it wasn't. What was our actual cost? 1,000. So IS2 says, I don't have a problem with you by adding unrealized profits, because probably there's a good reason for that. But remember, when you're going to compile your financial statements at year end, you have to remove all these unrealized profit components out of your figures, because you have to show inventory at year end at the actual cost price of that inventory, or if your net realizable value is lower than the actual cost price, at the net realizable value of your finished goods. So that means I cannot use that figure in my statement of financial position because it includes an unrealized profit component. And for that purpose, we have created the allowance. We have created the allowance for unrealized profits. Closing balance of inventory. Very important that you understand that the purpose of this account is to remove the unrealized balance or unrealized profits out of the closing balance of inventory. Good. So, included in our opening inventory, that was at the end of the previous financial year. We had, for example, finished goods at 550 Rand. Our policy is to add 10% to the cost of goods manufactured when we transfer it from the production area to the sales department. So we know that the 550 Rand was not equal to the actual cost of manufacturing those goods. If our policy is 10%, then we say, well, there was included in the 550 Rand, 50 Rand, which was 550 times 10 divided by 10, which is my unrealized profit component. So, in last year's statement of financial position, finished goods would have been showed at 550 less 50, only at a value, the actual cost price of 500 Rand. Good. Let's assume here at year end, once we've done our calculations, our closing inventory is 330 Rand. We cannot show finished goods in our statement of financial position at 330 Rand. We must determine what is the unrealized profit, take it out, and we're going to show only the actual cost price as the inventory figure for finished goods. Now let's go through this one. Allowance for unrealized profit at the beginning of the year, we've said was 50. We've sold those inventory items. So obviously that is not applicable. So we're going to take it out of the 50 and we're going to say, listen here, let's remove it. We have realized it during the year. So we take it out, we've sold it, we've realized it. Then we have added to the cost of goods manufactured. There, that's 1,000 Rand. We have added another 100 Rand, which was unrealized profit. So we're going to debit our finished goods account and we're going to credit this account with 100 Rand. At the end of the year, our closing balance, let's put it here, copy, will look like that at the end of the year. Do you agree? Closing balance, finished goods is an asset, it will have a debit balance. So we cannot show 330 as the value of finished goods. So if we take the 330, we multiply that by 10 divided by 110, that gives us then a final figure at the end of the year of 30. So the actual amount or the actual value of closing inventory finished goods is going to be the 330 less the 30, which gives us 300. Good. I cannot do a one-legged entry. So if I want to create at year-end an allowance for unrealized profit of 30, I have to do the counter leg of that transaction here. Let's do it here. Just give some more space. 30. Good. Credit, debit. So now we can say 150, 150. We have to make an adjustment against cost of sales of 120. Have a look clearly what we have done here. We had opening inventory plus goods manufactured less closing inventory. I remind you, opening inventory plus purchases less closing inventory. What was that? Cost of sales. That is why that is cost of sales. So what is going to be our total cost of sales? It will be that amount that we have calculated in our finished goods account, which is going to be a debit against the expense account cost of sales. We're going to debit this account and credit the cost of sales account, and therefore it's going to reduce that cost of sales amount with 120 Rand. Now, I don't have to give you this percentage. I can tell you the opening balance of finished goods was 550 Rand and the opening balance of my allowance for unrealized profit was 50 Rand. And then you can calculate the 10% yourself. What are you going to do? Going to say, okay, what is my actual cost price? It was 550 less 50 equals 500. That's my actual cost price. What was my unrealized profit component? It was 50 divided by 150. So my unrealized profit equals 10%. So I do not have to give you the 10%. I can let you work it out. And then once you've done your work in progress account and you've balanced it off and you have determined 1,000, you should know by yourself that you have to add 10% to the 1,000 to derive at 1,100. So that's the one thing that I can ask you to do. I can also tell you that the opening balance on my allowance for unrealized profit account was 50. And I give you the 10%, but I do not give you the opening balance of my finished goods account. But you could work it out, can't you? Because if you know that 50 equals 110%, then you can work back to 550. If I didn't give you the opening balance, and I told you that the unrealized profit component was 10% and the allowance for unrealized profit balance at the beginning of the year was 50, what would you do? You would say 50 times 110 divided by 10 equals 550. So the opening balance, you can calculate it now, is 550. Good. So I can let you do a few calculations. I can give you something, I can leave out something, and then if you understand what you're doing, you can start filling in the gaps. Guys, I want you to have a look. So usually you don't have a lot of problems in doing this first part. Up to work in process is usually fairly straightforward and you really don't have a problem with that. But where the most of the students are falling from the bus is when we start working with finished goods, allowance for unrealized profit, and unrealized profit P&L account. I wanted to take a few of your questions, which were good questions. You had a number of good questions where there was unrealized profits included in the question. And I want you to open that question and look at the memo. And then I want you to talk yourself through the memo, step by step, figure by figure. Explain to yourself aloud what happened in this question, how something was actually determined, and how the one figure links to the other figure. Now let me show you the links. That one linked to that one. That one is based on that one, so it links to that figure as well, and that links to this account. Now, this one will determine what the 10% is, so there's also a small link which you will have to know what is included in cost of sales and what is included in closing balance. So this figure and that figure links with each other. This figure and that figure links with each other. The movement on this account, the 50 and the 30, that links to this account. That figure links to this account. So I want you to start playing around with those figures to see exactly what links to what. And if I give you the one, how you can calculate the other one. If I can give you one, how you can calculate the other one. So talk yourself through a couple of memos. Don't do the calculations. All of us can do calculations. Talk yourself through those memos and you will understand exactly what it's all about.